Hello everyone. Welcome back to Stock Daily. It's currently 11:45 p.m. on Friday, August 1st, Eastern Time. Today, the four major market pillars collectively declined, with the S&P and Nasdaq experiencing their largest single-day drop since May. After more than a month of continuous gains, this sudden drop might be a bit unsettling for newcomers to the U.S. stock market. However, this is quite normal. After a few years, one gets used to it. Typically, the learning curve for new investors lasts about 2 years. As you go through more downturns, you gradually become accustomed to them. There is no market that only rises without falling. For veteran investors, while these types of declines might be unpleasant and lead to some profit-taking, the overall psychological impact is not very significant. Today's market weakness for the second consecutive day is no longer just about pension rebalancing. It's more about data-driven trading. One of the key reasons for today's market behavior is the weak U.S. non-farm employment report. Additionally, tariffs have now been fully implemented, raising the average U.S. tariff rate from 10.3% to 15.2%. While this figure is slightly above the market's previous optimistic expectations, it is still better than the worst-case scenario projected in April. To understand the broader picture, a 10% global minimum tariff is now being imposed on all imported goods, and tariffs on Canadian goods have increased to 35%. However, items covered under the USMCA agreement are exempt. Switzerland is a unique case, with tariffs being reduced from 31% to 3.19%. This change has drawn criticism from officials who argue it contradicts earlier draft terms. In total, imports from 40 countries now face a 15% tariff, while 12 economies are subject to even higher rates. China and Mexico, two major trade partners, have received a 90-day delay on tariff implementation. While this overall tariff situation is more optimistic than some expected, further changes and negotiations are anticipated, and some tariffs may decrease slightly. Turning to the non-farm payroll data, the numbers came in well below expectations. July saw only 73,000 new jobs added, compared to the expected 110,000. June's figures were revised down from 147,000 to 140,000, and May's from 144,000 to 119,000. These revisions represent a cumulative downward adjustment of 258,000 jobs over 2 months, marking the largest 2-month downward revision in this economic cycle. The 3-month average now stands at just 35,000 jobs, far below the 80,000 to 100,000 balance point mentioned by Barkin at the end of June. This clearly indicates very weak employment growth over the past quarter. The unemployment rate rose from 4.1% to 10.2%, which was in line with expectations, but still lower than the Federal Reserve's 2025 forecast of 4.5%. The labor force participation rate edged down slightly from 62.3% to 62.2%. Average hourly earnings rose by 0.3% month-over-month, meeting expectations, and 3.9% year-over-year, slightly above the 3.8% forecast. Average weekly hours increased from 34.2 to 34.3. Before key meetings in September, the Fed will have access to one more employment report, 2 consumer price index reports, and 1 personal consumption expenditures report. This gives the central bank plenty of data to assess its next move. The Fed is currently facing a dilemma, slowing job growth on one hand and rising inflation on the other. Powell and other Fed officials have said that if the labor market deteriorates significantly, it could justify a rate cut. On the other hand, many governors, including Bowman, believe the inflation caused by tariffs is temporary and should not lead to long-term inflationary pressure. Opponents of a rate cut argue that inflation risks still outweigh the risk of recession. After today's data, market expectations for a rate cut in September have jumped to 90%, up from less than 50% when the data was released. The market is now pricing in 59 basis points of rate cuts by the end of 2025, equivalent to 2 full cuts. Treasury bonds responded sharply today. Yields dropped significantly, with the 10-year Treasury yield falling 3.44%. This marks the first time since April 7, 2025, that the yield has broken below the 200-day moving average, a level often watched by investors. Although bond prices aren't primarily driven by technical analysis, crossing this level suggests that many investors who were previously underwater are now breaking even. This has boosted confidence in TLT. For TLT holders, the outlook may now appear more favorable. However, there is a detail worth watching. The Treasury Secretary has maintained a position against issuing more long-term bonds. If this stance changes, it could negatively affect TLT prices. After the release of the non-farm data and downward revisions to past months, President Trump posted a tweet accusing the Bureau of Labor Statistics of manipulating the data to harm his and the Republican Party's image ahead of the 2024 election. He announced the immediate dismissal of the BLS commissioner, who was appointed under the previous administration and confirmed with bipartisan support, including votes from 38 Republican senators. Several other economic data points also missed expectations today. For instance, the ISM manufacturing PMI dropped from 49 to 48, below the expected 49.5. Tariffs were a major concern among survey respondents. Some described the trade war as exhausting and said it made procurement planning difficult. Others said that tariffs made it nearly impossible to predict future costs and savings. These concerns reflect broader uncertainty in the business environment. Looking at the broader market, today's closing levels are the lowest since July 9th. This confirms the weakness, as positions opened since July 9 are now under pressure. Unlike the earlier rally, which left few overhead resistance points, any rebound from current levels will now face selling pressure. The key question is, how much further could this downturn go? There is no need to panic over every market dip. Corrections are a normal part of the market cycle. Most market moves happen in a spiral pattern, not just sharp rises or falls. If the market stabilizes after a small dip, it shows resilience. If it keeps dropping, then we treat it as a healthy correction. Knowing where a correction remains safe and where it becomes dangerous is critical. From a strategic standpoint, a large correction could be a buying opportunity for those seeking excess returns. If the market only dips slightly, waiting may be the better approach. Note that we're discussing the indices here, not individual stocks, which behave differently based on their own technical positions. For the S&P 500 index, a symbolic level is 61.88 points, although it isn't critical. More significant support lies between 60.32 and 61.34. If the market corrects to this range, the downside is likely limited. For those expecting a more shallow correction, this is a potential entry point. The assumption here is that the S&P's forward EPS for 2026 will be revised upward. A deeper but reasonable correction range is between 59.50 and 6.13, representing about a 5% drop. The most stable and favorable buying area lies between 55.70 and 57.51. If this level breaks, the current upward structure would be invalidated, and the index could retest earlier lows of 53.20 and 5100. On average, the S&P experiences a 10% correction annually. A 5% pullback typically happens 3 to 5 times a year. These levels are worth watching depending on your strategy. For SPX, potential entry levels are 5.98 to 6.07 for aggressive investors, 5.81 to 5.94 for more conservative entries, and 5.50 to 5.60 for the most favorable long-term positions. The Nasdaq is in a similar position, though it has a higher beta and could see a correction of up to 15%. We'll discuss the Nasdaq further in an upcoming segment. For the semiconductor index, potential buying zones are 215 to 233, with 204 acting as a critical support level. For the MHS index, look for 238 to 246. Because of different index compositions, these levels vary. Today our focus was on the major indices. We'll cover individual stocks in future videos. There's too much to discuss in a single session. Next week, we'll continue analyzing leading stocks and indexes. We've recently discussed companies like Nvidia, Tesla, Meta, and Google. While they've experienced minor fluctuations, their key levels remain unchanged. For example, Nvidia's support is still at 174, and Tesla remains a buy below 296. These levels are the same as discussed in previous videos. If you're uncertain, feel free to rewatch those episodes. Today marks the first trading day of August, and volatility is already picking up. It could be a very eventful month, so stay alert. A market pullback may create opportunities for new entries. We'll share our plans and adjustments in upcoming videos. Time flies. It's already a new month. As always, on the first trading day of each month, we wish you good luck in the markets. If you'd like to support the channel, just give this video a thumbs up. Thank you as always for your likes, comments, and shares. We'll see you again next Monday at the same time. Have a great weekend.